Today, we're taking a deep dive into KTC technology. Now, if you just glance at the company's reported profit, you'll see a decline. But beneath that headline number, the data reveals a fundamental business transformation in progress, a strategic pivot that we're going to unpack right now. So here's our roadmap. We'll start with our core thesis. From there, we'll decode the financials, examine the shifting business mix and the innovation engine that's driving it, assess how the market is valuing this change, and then wrap up with a balanced look at the risks on the horizon. All right, let's get right into it. Our core thesis is this: KTC is at a major strategic inflection point. What this really means is that the company's reported profit decline, well, it's telling the wrong story. When you look closer, core operations are actually getting stronger. The entire business model is pivoting away from low-margin legacy hardware and toward high-value innovation. And their focus is shifting from simply chasing domestic volume to building profitable global brands. So where is this disconnect coming from? To find it, you have to look beyond the headlines. We need to really decode the financials from the first half of 2025. Okay, so on paper, net profit fell just over 6%, but that figure is really misleading. Once you strip out the one-off, non-recurring items, you get to the core net profit, and that's the key indicator of operational health. And look at that, it actually grew by a very substantial 10.62%. But you know, the most compelling proof of this operational strength isn't even on the income statement. It's in the net operating cash flow. This chart shows a pretty dramatic turnaround. I mean, look at this. In the first half of 2024, the company had a net cash outflow from operations of almost a billion yuan. 1 year later, they generated an 800 million yuan inflow. That's a 1.8 billion yuan swing, and it confirms a major improvement in how they're managing capital and, more importantly, the quality of their underlying earnings. So what's fueling this financial turnaround? Well, it's being driven by a very deliberate shift in the company's business mix, moving away from legacy revenue streams and toward brand new engines of growth. As you can see, the legacy smart TV business still brings in over half the revenue, but that's not the real story here. The real story is the rise of that innovative display segment. Sure, it's smaller, but it represents where the company is headed. And this innovation segment is the new growth engine. Revenue surged nearly 40%. But the really critical metric here is profitability. The gross margin almost doubled, from about 12% to over 21% in just 1 quarter. This is exactly what that shift from low-value volume to high-value products looks like in action. At the same time, the legacy businesses are being repositioned very strategically. The smart interactive displays provide stable, predictable cash flow. Meanwhile, the smart TV segment is being managed as a cash cow to maintain scale and absorb fixed costs, with a clear goal of shrinking its dominance in the revenue mix. This all brings up a key question. What's the system that's driving this successful shift towards innovative products? It's not just luck. It seems to be a repeatable, structured process. You see, KTC's success here isn't an accident, it's a system. They've built this repeatable playbook: identify a user need, deploy their huge R&D team to build a solution, protect it with patents, and then iterate on it incredibly quickly based on real-world market feedback. This is how they de-risk innovation. And a perfect example of this strategy is their integration of cutting-edge AI. This strategic partnership with ByteDance isn't just talk. It's about embedding a powerful large language model directly into their next generation of products, like their upcoming AI glasses. So this innovation engine is now being pointed directly at the global market. There's a really clear strategic shift happening. They're moving away from prioritizing domestic market share and volume and moving towards capturing higher profit margins through international direct-to-consumer channels. This fundamental shift in strategy naturally leads to a critical question for us as analysts. Does the current market valuation reflect this new operational reality? As sum of the parts analysis helps us see the company's true structural value by assigning different valuation multiples to each segment, a low one for legacy TVs, a moderate one for the interactive displays, and a high one for the innovative products, we can get a much clearer picture than a single blended average could ever provide. Now, when we compare KTC to its publicly traded peers, we see a potential valuation misalignment. KTC's multiple is actually lower than its direct competitor Siwo, even though it's showing much better growth. At the same time, it's valued substantially higher than a traditional manufacturer like Hisense, which tells us the market is partially recognizing its evolving model, but maybe not fully. But to maintain a balanced perspective here, we have to consider the risks. This transformation, as promising as it looks, is not guaranteed. So, while the transformation is evident in the data, there are significant risks to keep an eye on. First, there's execution risk. Their success hinges on continuing to launch new hit products. Then you have margin pressure from intense competition and volatile costs in the legacy businesses. And with over 80% of revenue coming from overseas, the company is definitely exposed to both macroeconomic and geopolitical headwinds. This all leaves us with a final, critical question. The case of KTC Technology really highlights a broader challenge for analysts today. As hardware and artificial intelligence continue to converge, how do we properly value a company that's right in the middle of such a fundamental transformation?